featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
Welcome to Your Money, Your Call, Bonds versus Equities. My name is Mark Todd. I'm from FIIG Securities, and if you have any questions whatsoever about investing, please pick up the phone and call us on 1300 30 34 35 and the email yourmoney@skynews.com.au. Joining me tonight on the panel is Craig Banning. Craig's from NAV Wealth, and we have Carl Capolingua. He is Head of Education at the Australian Stock Report. Craig, you're a Director of Wealth and you're an advisor for NAV Wealth. How's the advisory world been in the last month? You know, we're June 30.
Well, it's never dull.
Bang it on.
You know, it's never dull. With volatility, it's all about spending more time with our clients at the end of the day. Although I've got to say, clients amaze me just how resilient they've become compared to 5 or 7 years ago.
Because it's just been the volatility is like, is it such that we were talking before we came online? Do you think they've become immune to some of the volatility, seen that's part of life and take it, or do you think they've just stopped? In other words, they've stopped investing, they've gone to cash, they leave it alone. What do you think's happening, Carl?
Oh, look, I think it depends on the level of understanding of the client, the level of education as well. Also, I mean, my clients are quite different from your average run-of-the-mill mum and dad clients. I mean, the reason why they came to me in the first place is because they wanted something a little bit different. You know, we're pretty aggressively long and short, so if the market gets volatile, obviously that means upside and downside volatility. We can really attack that short side and use some derivative positions to protect some of that long side exposure, which is what we've been able to do over the last few weeks.
So let's grab it there. What do you mean by that? Do you mean, are you just selling some calls and puts? Is that what you mean by talking about derivatives, or what's the overlay that you're looking to do? Yeah,
look, some of my clients do like to use options and sell calls, or sometimes buy puts for protection. But I guess the primary tool that we use these days to get short for mum and dad investors are really contracts for difference, or CFDs. So I don't know how much you want me to go into what a contract for difference is.
Sure.
But,
I mean, just talk about it as if you. I mean, I think in terms of the leverage that it has in that and the risks around that, I'm interested from the viewer's perspective about what you think the risks are with a CFD. Clearly they've worked for a lot of people. And not always been CFD providers make a lot of money as well, so there's lots of margins in it. But how would it work? I'm long, let's say CBA, Telstra, whatever else, 4 majors, the 5 majors, 4 banks and Telstra. What CFD are you going to ask me to take on? Yeah,
look, I mean, each stock has its own CFD associated with it. And look, CFDs aren't all that much different from actually investing in the share itself. There's just that leverage component. And I run 2 portfolios for my clients. There is a more of a shorter term trading portfolio, which is the long short one, and then the longer term self-managed super fund portfolio. And we don't use CFDs in that one. That is being a long only portfolio. Really only defence is to go from being invested into cash and actually bonds. So it's good to be on a show that's primarily about bonds, because it's something that we do like to use from time to time. But certainly in the shorter term portfolio, we do use those derivative products to hedge ourselves. So a lot of people say, oh, look, aren't CFDs really risky products? Well, I guess they're really risky products if you've got $500 in your account to trade with. You put $500 on one trade and you blow it up on the next trade. But if using CFDs as part of your overall investing approach, part of your risk management approach, and you're actually targeting some of the weaker stocks out there in the market. So you mentioned the likes of CBA, some of the banks and Telstra, and there's some of the stocks that we have had long positions, invested positions in over the last sort of 6 to 12 months. Certainly we've been overweight in that area of the market. But more recently, and you know what? When Bernanke opened his big mouth back in May, and cent rates skyrocketing, obviously killed those positions for us. We're very fortunate to have a number of quite aggressive, quite strategic short positions in mining services, and in particular gold stocks.
So Craig, you're the advisor, and we've got Carl here, and I'm the customer. If I have $1 million worth of equity and I've got $1 million worth of bonds, and obviously I've been very lucky, I've got $2 million, which I don't have. How much does the CFD cost me in general, what am I expecting? And then, Craig, can you tell me, do you think it's a good idea? Am I putting down for my $2 million portfolio? I'm not worried about the bonds. I've got senior bonds. They're less volatile. I'm okay. Do I spend $100,000? Is that what you have to put in my account, or 10%, or what am I looking at? What should I expect?
Yeah, look, I tell clients it's less about CFDs and more about long-term versus short-term. So, you know, I'm of the philosophy that buy and hold died in 2008. So, and I think most of my clients are there as well, psychologically, and that's why they're with me. So, we're pretty active even on that longer-term portfolio. We'll turn stocks over when they start to go the wrong way. We're pretty big on risk management, and I suggest people have it's the old 80-20 rule. So, about 80% of their portfolio for equities. Based on the longer term investing, which, as I said, is long only, and about 20% in that long short portfolio as well, which is typically done with CFD. So that's about the
okay, so far it's 20%, so it's $200,000, and I'm going to crank some CFDs. And
well, you don't put all your dough into the CFD. So look, I think there's a lot of misunderstanding about CFDs. If you're going to go out and buy 1,000 ANZ shares, go out and trade 1,000 ANZ CFDs, and your risk is identical. The difference is how much capital you put up, and you're only going to have to put up about 5% of the capital. But if the power of the leverage goes to your head, and you say, well, you know, instead of having to put up 5%, I've got all this extra spending power. I'm going to do, you know, in theory, you could do 20 times. You could do 20,000 shares for the same amount of dough. Well, you're going to get into a lot of trouble. But if you pick it on a like-for-like basis, I would have done 1,000 shares. I'll do 1,000 CFDs. Your risk has to be the same. So it's still 1,000.
So what do you think? Is that what we should be doing?
I guess how we look at these things is we centre everything around our client. Yep. So at the end of the day, our client comes to NAV Wealth. At NAV Wealth, we have accounting advisors, wealth advisors, financial planners, in-house, all together for our client. And then when we need specialist advice, and this is a good example, we'll then go out to the advice partners we work with, and those advice partners will come in and provide the advice such as CFDs to our clients if that's relevant to our clients.
Do you do any CFDs?
Very little. Again, my job is to facilitate the process. So again, you know, if Carl was one of our advice partners, we would have Carl come into our office, meet our client with myself or one of our other wealth advisors. Yeah.
So tell me a little bit about NAV Wealth. It's AMP. Give me some.
Yeah. So we're an accounting, financial planning, wealth management, financial planning company. Our license is with AMP Financial Planning.
Yep.
We have about 20 people, and we don't have a lot of clients. We're a very high touch sort of model. That way we're seeing, at the end of the day, our goal is to sit down with a client, work out where they want to go in their life as a couple, bring it together, work out the strategy to get them to where they want to go to, and then review that strategy on an annual basis. Has that
business been growing? I mean, I think, you know, Carl's spoken about the GFC. So one of the consequences of the GFC was that no one trusted anyone. That's just bad luck. You know, I don't believe anything you're saying. You seem like a nice place, but I don't care. You're not getting my money. And the first thing I want to know is how much money are you earning before we even have that conversation. So how's your business recalibrating and growing since a consequence of that?
I think in our model, it's such a high touch model. It's not like we've got 10,000 clients.
Annoying. I mean, high touch could be annoying.
So it can be. So at the end of the day, you've got to get the right client with the right advisor. If you have the wrong client with the wrong advisor, it will be annoying, but generally it's not, because you have the right client with the right advisor. And at the same time, I think our clients are very advice seeking type clients. They don't want to do it themselves. They want to have somebody partner them in their journey, and I think they look to us as their trusted advisor.
So would, you know, the fastest growing sector of the market of all investment markets at the moment is self-managed super funds. That is the number one, and it FIIG, I mean, it's been one of the reasons why we've been as successful as we are, because people want to have control. They want the education, they want the knowledge, they want to see that they can see their own portfolio. They're not necessarily moving into a manager. And maybe because fixed income's grown so much, we've reaped the benefit of that. How about your customers? Is that what's driving them? They want the control, they want the education, they want to get up the curve?
That's you just described exactly our clients there, and Craig's quite correct. You know, we're more of that strategic. We play more of that strategic manager role. We don't handle necessarily structures and tax and things like that. And that's where your financial planner would come into it. But if you've got a pile of dough that you want to work as hard as possible in the equity space, that's where you'd come and see either me or the Australian Stock Report team. But certainly, our client is very much the self-directed client. They've probably had a financial advisor or a planner, or even a broker who might have not done as well as they probably should have in the GFC. And people, you know, it's there's still a lot of sore sort of memories
and rightly so.
from that era, and that you know, the old philosophy of, well, why am I paying these guys to lose my money? I can do that myself. So whether that's right or wrong, these people are coming into the market for us, and you know, we're seeing quite a you know, push in our business from a growth.
Let's talk about that after the break. We're going to have a very short break, but please, if you feel like calling, call on 1300 30 34 35 for any questions around investment, and email yourmoney@skynews.com.au. We'll be right back. Welcome back to Your Money, Your Call. Tonight I'm joined by Craig Banning from NAV Wealth, and I have Carl Capolinga, Head of Education at the Australian Stock Report, and we have our first caller for tonight. If you want to email us on yourmoney@skynews.com.au. We have Chandrell here from Newcastle. How can we help you?
Hello, Mark. Great show. I just want to get your opinion and the panel's opinion on IABs, or indexed annuity bonds.
Yep.
From a self-managed super fund perspective, is that a good buy?
The short answer is yes. I mean, I think index annuity bonds and capital index bonds and anything to do with inflation linkers are a good buy, but then you drill back down and say, which ones are you talking about? And that's the key to all those questions. I think, I don't know whether you guys are familiar with any of these index annuity bonds or any of these sort of products, but there are a couple that I like. I always talk in the show about Sydney Airport Linkers. That's a capital index bond. It grows over time. The 2030s. Everyone, when I say 2030s, everyone goes, that's so long. But my problem with index annuity is, at what point in time does inflation, you know, start to move in? And you might as well go as long as you can. That index annuity bond, capital index bond, sorry, just traded today at 4.8. So that's, you get 4.8 plus inflation. Yeah. Well, you know, I think inflation is going to be higher than people anticipate, but at the moment it's at 2.5. Yeah. So you're going to get low sevens for senior bond in the Sydney Airport. So Sydney Airport as an equity, that trades at about, I think it's about 6.3. You might have it quite closely at hand. So, but I think if I can go to a senior bond and get something in the sevens versus the volatility in the equity, you know, that might make some sense. The other one I like is I think called Preco. Preco is it's an annuity bond. I like the annuity. It gets you close to 6% for an index annuity, and Preco, for the viewers that don't know, is the Defence Housing Building. So it's a public-private partnership. It's a nice bond because getting 6% on your cash is quite a reasonable return, I think. Familiar with any of these products?
No, look, a lot of my clients are starting to ask about these index bonds, actually. Yeah. So it's something I need to watch this show a little bit more for, Mark. But you know, obviously, you know, we're more equity focused at Australian Stock Report. But you know, obviously I run workshops for mum and dad investors, but there is a higher level that people can adopt with me. It's called my Elite Traders Club, and in that area, we do actually actively tell people to move into bonds when equities aren't looking good. And I think you'd be silly to just leave your money potentially rotting away in the market if we are on the verge of a 3-year downturn and not have some exposure there in the fixed interest side.
Craig, what are your clients doing in the term deposit piece?
Yeah, it's now getting to the hard time, because I think 1 to 2 years ago, clients were going, great, let's buy stocks with income, and they were very happy with those income stocks. We've all seen what's happened in the last 12 months. It's probably only been in the last 3 months, clients are now saying to me when they come in, I'm now getting worried about the rate of my term deposit, Craig. What's the alternatives? But they've still got a lot of fear in their mind. They're still saying, I want to know where the money's going. If I go into a bond fund, I want to know where is it going inside that bond. Yeah, and I think that's what's different with self-managed fund clients today versus 10, 15 years ago. They just want to know where their money's going.
Yeah, we've had Roger Tyndall on as a fund manager, and Roger makes a very good case about why you should be buying bonds, and he talks around all. But at the same time, people want to say, I hear all that, but I want to know what bond you're buying. Are you buying that one, or are you buying that one? Which one are you? Because I feel I deserve that level of education, and that's entirely appropriate. I think people need to know what they're buying. But the things that I'm curious about at the moment is I went down and saw the cash people down at FIIG. Now I think they've got about a little bit over 8 billion. They've got a lot of money, trust me.
Yeah.
And they said it's really hard now to get 4% for something in a term deposit.
Yeah.
That's hard to imagine. How do you're talking about getting business out of the GFC, but the other thing that happened when GFC was term deposits went through the roof.
Sure.
Some of those rates were amazing.
Rates were 6.5%.
You get Suncorp and all these organisations pay 10% that matured in the last year, and people are repeating getting that 10% maturity and getting 4.5%.
And inflation's at 2.5%.
That's a pretty hard road to hoe if you want to take that. So when somebody says I'm nervous, if I come in as a customer of yours and I say I am the most conservative person you've ever met, and I have $1 million. Where will you push me?
So I guess what we're doing in that space is really coming down to the individual client, because that's who's in front of us.
So a young man like myself.
And exactly right.
Thank you.
Exactly, Mark.
That wasn't the joke. The joke comes later.
We start, I guess, with an education. Okay, what are the options around the defensive part of your portfolio? Because what I think we see is that clients are quite happy with the growth element of their portfolio being volatile. They understand that now. What they're worried about is the defensive side of their portfolio being volatile. That's the part that rattles them. So we talk, so generally what we've found is we've got to slowly introduce them to the bonds, the hybrids and the Sydney airports of the world, because if we basically move them all from term deposit to straight to those types of fixed income, they just don't want to take that risk. So it's sort of a slow moving, over we go slowly.
Subject of it being appropriate. We have our first email for the night. It is an email from Susie from Newtown, and Susie writes, with the sell-off in the currency, how is it affecting bonds? I suppose we can expand a little bit on it. How currency sell-offs, how has it affected both your businesses? Has there been clients concerned about it, and is it relevant to all you guys? Or, I went to a conference where I was talking to a planning group, and they had said they'd put all their customers into US dollar equities. So how's the sell-off? I mean, having done that now, they'd be making money, but are you seeing much in the way of the currency-driven business?
A little bit. I shouldn't say this, but a little bit more born by accident than anything else.
Got to have luck.
Again, I run, within the portfolios I run, there's two markets we cover, and there's the Australian market, the ASX, and the US market as well.
All right.
So we're pretty big on getting your money out of Australia and working hard when Aussie's not the best place to be. So the vast majority of my clients have significant investments in the US market, and therefore, I must admit, by more luck than anything else, those investments are all of a sudden up 10% for really not having to do a whole lot. So I guess if there's a message in there, it is to have some diversification, not only within a market but across markets as well.
In answering to Susie's question about the affecting bonds, there are a lot of Australian issuers in overseas in other currencies, and the sell-off has been in the currency has been one thing, but it's also been the credit sell-off. So what happens is that issuers like Suncorp, Westpac, CBA, they get sold off because foreign owners of those credits, those names, are not necessarily that familiar, and they go to a safe haven. They might go to a Morgan Stanley, Barclays, depends where they are, what their jurisdiction is. And so that becomes pretty good buying opportunities for those people that are similar to Carl's clients who have got US dollars or euro or whatever it might be, and they look to take advantage of that. We've seen a lot of CBA Tier 1 paper trading. We've seen a lot of the Australian names trading because that sell-off has become quite attractive in credit terms. What about you and your clients with offshore?
It's interesting. I was just thinking then how Australians used to love, or still probably do love, residential property. I think they also do love Australian assets, be it shares. As soon as you start to talk to a trustee of a self-managed fund, let's talk about international shares, let's talk about international bonds, they nearly glaze over. It's actually a huge challenge, which you probably see in your the education sessions that you run, Carl. So again, it's just chipping away. It's important to have assets overseas. These are the reasons why. And I guess bring it back down to the individual client that's in front of me and talk about this is why it's good for you to have this. And I guess we resolve that by first focusing on the income. If a client's retired and we've got their portfolio, it's producing the income that they need, then it starts to get easier to start to look at growth assets and overseas assets.
And we can talk about the fact that they might be travelling overseas and they might be having different uses for the cash. But we are going to go to a break, and before we leave it there, we're going to go into our great speakers corner, and we're going to start first with Carl, and time starts now.
Well, in terms of strategy, I'm strongly recommending that now is the best time to really review your current approach. We've talked already tonight about the importance of diversifying yourself in terms of direction, so having a mix of positions geared towards a rising market, but also bringing in a small part of your capital into taking advantage of a falling market, diversifying across markets, so getting out of just the plain old Australian Aussie shares and into the US to get some currency exposure there, and most importantly, having a good trading plan, a good investing plan on how to do it all.
Well, welcome back to Your Money, Your Call. I'm Mark Todd from FIIG Securities, and we have another caller for tonight. We have Dennis, who's Dennis calling in from Victoria. How do we help you, Dennis?
Good evening, guys. Look, I want to buy some bank shares. I can't afford CBA. They're out of my reach. So it's a choice between National Bank, Westpac and ANZ. I've been told that ANZ long-term would be the best buy. Of those three, NAB, ANZ and Westpac, I just wonder what you guys thought.
I suppose... I get the idea that CBA has come back so quickly. It's almost at $70 again, and I understand the idea that CBA will pay a $2 dividend roughly, and everyone wants to buy it because it gets it in August. For the first time in my working career, they have all different stories. CBA is going to be the IT bank, NAB's the divorcee bank, ANZ will be the Asia bank, Westpac is all the different brands that they're going to recalibrate, Bank of Melbourne and so on and so forth. So I get all that, and to Dennis's question, which one offers better value than the other, I think they're all the same in terms of their performance. And the thing, Dennis, that we are, it's not necessarily trying to be crass, but the reality is the people that run those banks know what they have to do, and I mean the top 5 people of that bank, and all they get paid is a lot of money to get that equity price up. And if it means bang, you're gone, you do his job and you do your job, so be it. I mean, I think that they understand the contract they've engaged in, and so I think they're all pretty good. It's just a question of who you're most familiar with, and that's my spiel. Any of them will be fine.
I had flashbacks to Mark Burrowside, Celebrity Apprentice. They're bang, you're gone.
Yeah, well, mate, they are bang, you're gone. They do bang, bang, bang for sport. I think they do it on Thursday just to practice.
That quite well.
I mean, they are definitely bangers, those blokes. They watch Mark Burrows, not me. I don't bang anything.
Banks?
Banks.
Which one's the best one?
What do you like?
Oh, well, can I say I don't like any of them, perhaps?
Sure.
And I think a little bit of flawed logic there in terms of saying CBA's too expensive, I can't buy it. Certainly CBA is about a $70 stock, the other ones are around about $30. Well, that just means you buy half as many CBA as the other ones. So don't look at the share price and say, share price is too high and therefore the stock is more expensive. That couldn't be further from the truth. In fact, you've got to look at more than just the price of the share. So look, all 4 of those banks are going to struggle to hit over double-digit earnings growth over the next 12 months. So I'd put back on the caller, do you need to buy a bank, or do you want the best performing stock in the next 12 months? And if it's the latter, don't buy any of those banks, because I don't feel any of them are going to be the best performing stock in the next 12 months. If it's a pure lock it up and yield play, then Mark, you've probably got some better things to do than buying those bank shares on the bond side of things as well.
Well, yeah, I think the banks will perform really well only because of what they are, the way their nature is. They've got that very tight monopoly. I understand that credit growth is no good, and I go back to that same premise. They are going to, if they don't get credit growth, they're going to get productivity growth, and that means if I'm sitting in teller number 1, I'd be nervous. I mean, what about you on banks? You like any? We've got another caller from Eric, so we'll go to that. So you've got to be quick, Craig.
Okay.
I'm sorry.
How we would handle this with Eric is we would sit down and say, what is your objective? Where are you trying to go? What income do you want? What capital growth do you want? We would then design the asset allocation and would bring in the expert on the equity side to recommend the portfolio. That's what we'd do.
For Dennis, that seems very reasonable. Dennis, you've got to buy one of them. Have a crack. Eric, how can we help you?
Thanks, Mark. I'd like to ask Carl, last year he advised to buying REA Group. I bought around $12, it's now $27. Maybe what should I do? Also, last year he says to buy American shares. This time last year he's saying specifically JP Morgan Chase. Apparently it hit some whale. I'm not sure, but I paid $31 US, now 52. What should his advice be? Maybe add more or sell or whatever. But now with Dula going down, I'm really making more profits. Thank you.
Gee, how did you get that call through?
Yeah. I don't know.
Eric, we want to thank you for calling through. That makes Carl feel very happy. He's come all the way from Perth. He feels much better for the trip.
Having flashback to the equity show here, Mark.
What are you thinking? Do we sell all the US banks, are they a sell yet at these prices, or do you think they go again? Because I know that when Capstream and those sort of guys were on the bond show, they really like the debt on those. You know, they just think the US economy is really going to perform very well, and the banks will reap the benefit because they're just the cash cows. So what's your thoughts on the US banks?
Thoughts on US banks, thoughts on US market in general?
Yeah.
That's an easy one, isn't it?
Yeah, well.
Look, on Real Estate Australia, I can say, look, depends a little bit on your time frame. If you're a shorter term trader, Eric, and you've had it for 12 months, so maybe that's not the case. But if you're a shorter term trader, I'd be looking to lock in profits on real estate at this point in time. I think you've had a fantastic run. In terms of the price action that I look at, it does seem to be breaking down here from a demand-supply perspective. So certainly a lot more supply coming into the market at this point in time than there was, even 3 months ago. So we've gone from a market on Real Estate Australia Group who's thinking, where can this go to? How much money can I make? My profits are swelling and swelling. You've had this big top, this what I call a supply event in the market. Now the psychology changes. It goes to, you know what? I reckon it's a good time to get out of this thing. I reckon it's a good time to crystallise my profits and look elsewhere. And I think probably that run is over. If you're a slightly longer term investor, then it's pretty much line ball here. And you know what? Saying that, I'd probably be getting out from a long term perspective on REA anyway. In terms of US shares,
double sell. Yeah.
that is a double sell.
Eric,
in terms of
you're
US
saying
shares,
get out quickly. You've got an overnight order.
US shares is going to be a tough one this year, and I've been a major believer and champion of investing in US shares for the last 18 months. I think they've had all the tailwinds behind them up until May 23rd, May 24th, and good old Helicopter Ben has just taken away those tailwinds. I wouldn't say he's put any headwinds in front of them just yet, but those tailwinds are gone, and I would expect that the next 12 months on US shares probably won't be as good as the last 12 months, so you might want to take some profits there as well.
That's a double sell with a top. Tell me about the chase for yield. Let's switch gears a little bit. I mean, we're talking about the banks. Everyone went into the banks for the yield. Yeah. How's the chase for yield affecting your customers? And we will be quick because you'll be going to the Speaker's Corner in a second.
So how's it affecting them? Yeah, absolutely. It's a big thing on their mind at the moment, as we said earlier, with the term deposits dropping. So I think, places like where you're from, FIIG, are going to explode, I think, as clients move more and more into that space and do chase the yield, because they're now worried about the high dividend stocks.
Yeah, it's been harder to sustain. I mean, when you're putting out notes saying, look, they aren't going to get the credit growth, people are they believe it, and I'm just being contrarian because I think that they know that as well, so they'll make those productivity adjustments. And when you talk to people in banks, they said, I've just missed the productivity adjustment, which means I've still got a job. We're going to have to leave it there, but before we do that, we're going to go for a quick break, but we will crank up the Speaker's Corner. And Craig, you're going to have 30 seconds, and get ready. Your time starts now.
Okay, I believe all investors should have their own personal principles when they invest. Some of those examples could be, first of all, don't buy what you don't understand. Number two, don't let emotion get in the way of the investments that you choose. Number three, make sure your time frame and your risk profile is suitable to the investment that you make. Number four, make sure that you understand the income and growth characteristics of the investment. And last of all, seek advice if you don't understand it.
Welcome back, and just a reminder, if you have any questions tonight, please give us a call. You want to talk about the share market or the bond market, 1300 30 34 35, and the email yourmoney@skynews.com.au. And the phone calls are running hot. Andrew from Canberra, how can we help you, Andrew? Thank you, Andrew. I'm sorry I've offended you. Look, we'll go to an email. The email we've got right now is from James. James from Melbourne. He writes, we've seen both equities and bonds sold off over the last few weeks. Where is all the money going? That's a great question.
It's a great question.
Yeah.
It is a great question because
that question.
If I went down to the cash people today, the term deposit, and I said, how's it all going? They said, all money, banks don't want it. They just don't want all the money. So what are the people doing?
We joke. I run a nightly webinar for my clients. They all tune in from all over Australia, and the first thing we start off with, actually, you'd be quite happy to know, the first thing we start talking about is bonds and what bonds are doing, because you can't understand the share market without understanding the bond market.
Okay. What is the bond market doing?
What is the bond market doing? Well, look, we've seen bonds, so yields spike. Okay, so yields, it's really all about Ben Bernanke and what's happened in America. So you've seen yields go from 1.5% at their low. You'll correct me if I'm wrong. On the 10-year notes in America, up to about 2.7% a couple of nights ago. On the 30 years, they've gone from about 3.7 up to about 4.5. So we get all excited over here about the Reserve Bank cutting rates by 25 basis points. Well, they've had basically 100 basis point increase in interest rates over in America on the 10s and about 75 on the 30s. Now, the 30 years a mortgage rate. So when that's what's stuffed up the stock market, first of all.
Well, I think it's because the air left the stock market in advance of that, and he was a confirmation that the air was going. So I get that. US 30 years, definitely this market moves up. What's really interesting, I used to work in the States, so I've got that connection with those people, right? I'll ring them up and say, "What's your mortgage?" Oh, 380. Seriously, they just give you a break, So Bernanke identified the fact that the mortgage market was going to provide the resolution to their problems. He really, certainly the currency and the manufacturing piece, and it absolutely for 7 years, the construction sector didn't provide $1 to GDP. So now it's going to move up.
But so shot across the bow,
correct.
Over
so that
the last
says to me,
few weeks,
interest rates aren't going to go up.
Yeah. Well, he can't afford them to go up any higher than right now.
So who's selling the US 30 years?
Yeah. Well, I think. And
why does it affect the Australian equity market?
Well, look, I think it got to be a really, really crowded trade, unfortunately, and stop losses and the like, and computer trading. And when it started to go the other way, it went the other way pretty quickly. And a lot of moves these days in markets are exacerbated. I think the question is not what's happened, but where it's going to go from here. And I think. Interesting. In his last press conference, Ben Bernanke scared the pants off people and said that rising mortgage rates, he's not worried about it.
We got Andrew back. Andrew, how can we help you from Canberra?
Oh, g'day. My question is particularly for Cole. I'm looking at two particular stocks to short. The first being IGO. This particular stock seems to have crashed through support, and I'm just wondering for a price target. I'm looking at maybe $1.60 or something like that from where it is at the moment. And the other stock I'm looking at is ANG. Is it a good stock to enter if you haven't shorted it yet? And also, I'm just interested to ask Cole about he refers to his nightly webinars. So how do you become a client of his? Can you please let us know? Thank you.
Andrew, thank you for calling back. I hope it's not too cold in Canberra. I hope Julia's all right and Kevin's all right. Let's work out. IGO and ANG, are we going to short them? It's a yes/no. He's got to get back to the football.
Look, they're both. Look, certainly IGO, yes, it's one that we're actually short already. In terms of your target, 160, you can probably go a little bit further than that, down to the low ones, 110, 112. As far as the reward to risk on what you've got left in it, there's probably not enough, in my opinion, to have a crack here. ANG, also one that's extremely bad. I think it's probably had its run. I think $3 is probably the level for ANG. But Andrew, if you're looking to short a couple of stocks in that space, I've just put out an order tonight to my clients to short FGE and Leighton's as well. Monadelphous and Worley also look pretty bad. We've been short that whole sector.
Clearly, it's not a good market, the equity market.
Well. Yep.
And if you want to find out his website, I'm sure it'll look it up.
AustralianStockReport.com.au.
That is,
That's
and
right.
he can, we'll strap something later on. Now. Shorting clients. A lot of people want to get short. Equities are doing something. Let's talk about your business. We've been talking about a lot of the shorting. We're talking a lot about the equities and index hugging. I mean, I'm curious about when somebody says I want to go into the US market. Yeah. You'd look to go into an index. Is that how it would work out for NAV Wealth? Well, and what do you do?
Yeah. So
and the other, I suppose, the other question is. Product supply, is that an AMP dominated space, or do you say, look, hang on, we'll buy a bit of this, we'll buy a bit of that? How does that work out?
So the first question is, I guess, when we go offshore, what are we going to do? To try and find a fund manager, the best fund manager that everyone seems to chase is extremely difficult. Yeah. So at NAV Wealth, we have a philosophy of let's go index with the proportion of a client's portfolio, which depends on the client's risk and the client itself. It could be 70% of the portfolio, it could be 80%, and then with the remainder, then look at a fund manager that's hopefully going to shoot the lights out.
Yeah.
Now in that space we have external research providers, and like pretty much most advisors these days, the recommendations are across many different fund managers right around the world. You know, gone are the days that if you're under a particular licensee, you can only recommend their products. I mean, that
seems stupid, doesn't it?
Oh, it left 10 years, 15 years ago.
Disaster.
Long time ago.
Not that AMP's not a bad organisation, it just means that limitation to what you can do, doesn't it?
Yeah, exactly. And these days clients want to know that you're there to provide them with the right solution for them, client first, and that might be across 5 fund managers, 10 fund managers, depends on the client.
How did Bernanke affect you in terms of, obviously Carl's got some hitters about him, but how did Bernanke affect you?
For me, it was that week was all about clients, and I probably had more comment about that than anything for a while, because clients would come in and they'd say, Craig, I don't understand. Isn't it just normal that if he stops printing money because the economy's picking up, isn't that just normal? Why is this such a big deal? That was the constant feeling of everybody that came in the door.
And of course, he didn't actually stop printing money. He said, we will start considering, and if the
slow down. Yeah.
The economy continues to improve, we'll be into that position. Yeah. So that's a reasonable thing to answer.
It's more the pace of it, I think, Mark.
But he has to give you a pace. Yeah. He said, I'm going to consider with data, and he's always been consistent with this. You can read this in the break. It's from Dudley. He said, "What are you people talking about?"
But we are saying that Dudley was exposed. So Bernanke said, he quoted, he said that end of 2014 was the time they were now expecting unemployment to get below 6.5%. Yep. Previously, that was 15. Prior to that, it was 16. Yeah. So this has been coming in. So money is always trying to get the highest return for lowest amount of risk, and up until the 23rd of May, that was in that particular trade. So it was to be
that heat was in the system. That's not. Yeah, he has to respond to that. He has to respond to what the Feds were saying, and he can't slow the progress of the employment. Like he's saying, look how anemic it was. I'm thinking 2016, 2015, 2014. Only because the employment, if you chart that employment, it's pretty substantial what they were doing, particularly in the fiscal drag period. So Bernanke said to the politicians, don't do this fiscal drag, it'll wreck employment. And of course, employment continued to improve. And he's going, hang on a second. Yeah. Once this fiscal drag gets out by March, whoa, hello, this has got some real headwinds. Yeah. And then we have to, and he looks to the Republican questioner and he says, well, we're going to consider it. And then he has to come out and give you a speech and say, well, we are actually going to consider this. Yeah. That sort of makes sense. I actually think as Bernanke moves back, it's going to be naturally bad for equities. And I don't mean that because I don't own equities. I do own equities. But I think, and I'm the standalone guy on this, I think it's really inflationary. His pulling back is really inflationary. And the reason why I think it is, you had a jobless recovery, so lots of organisations made a lot of money. Now you'll have a jobs recovery. Well, the first thing you're going to do, if you didn't have a wage rise for 6 or 7 years, is say, can I have a wage rise? And I just think we're going to see real wages pressure in 2014 in the United States.
If they get the rate down. If they get the rate down.
Yeah, that's what I'm saying. Sure. If they get that rate down, if they get that rate to where they are and say, we're going to pull back, well, all those people are going to say, well, instead of having 5,000 people wanting that job, there's only a couple of hundred, and I've had 3 years experience, 5 years. I just think there's going to be a real...
That's a long way in the future, but I think, look, to get back to this point of why the market sold off, is if you've got X billion dollars on this trade, which was the best trade in the world for a long time, and you thought you had this amount of time left, now all of a sudden you've got 1 year left, some of that money's going to come out.
Got to get it out.
All heads at the same time.
Talking about heading out, we're going to head out for another quick break. We'll be right back. Please stay with us. Call us soon. Welcome back to Your Money, Your Call. I'm Mark Todd from FIIG Securities, and we're still taking your calls on 1300 30 34 35. So feel free to call or yourmoney@skynews.com.au. Let's talk about inflation. I love inflation. The accelerated depreciation of all your assets, it's inflation. No one really trades against it. What are you talking to your clients about inflation? What's your expectations on it? How do you think, both here in Australia and offshore, how's that going to affect both your clients?
Yeah.
I'll start with you.
I'll go first. I'll go first. So we talk about inflation a lot, and the reason we do is because many clients go, Craig, I've got a self-managed fund. Why don't I just put it all in term deposits? You know, we do get that question, and because it's been a while since we've had high inflation in Australia, some people are forgetting about that. So we start talking about just how inflation really does erode the value of people's portfolio, and even if you are retired and you're 65 years old, it's extremely important to have growth assets to combat inflation. So I guess we come around to talk about inflation by introducing the concept of growth assets.
So that's equities, that's that sort of stuff that you...
Property, equities, well, exactly right.
Yeah, property linked to inflation, I guess. So if you buy a REIT, you think that rental stream is linked to inflation, so therefore it's an inflation buffer.
Exactly right.
What about your guys?
Look, I think my expectations for inflation is that we're less likely to see higher rates of inflation than we are to see lower rates of inflation. I think we're in a situation right now where central bankers around the world are trying to create inflation, and consistently, month after month after month, we're just not seeing it. And I guess how much money do you have to throw at it until you get it? I guess there's some talk in the US that there may be less money being thrown at it. So I actually think we're more likely to see a very low inflation environment going forward than a high inflation environment. Problems in Europe, China could, we've got potentially deflationary environment in China now. So I think we're at the very thin end of the wedge of this being in the news and talked about.
Are you talking about globally? Like in terms of Australia, what do you think?
Okay, very different. So in terms of Australia, look, we might get a little bit of a bump here, obviously with the pullback in the currency, which is going to be more inflationary locally than deflationary. But I think that'll be more than outweighed by the bearish global picture, I think, going forward for at least the next 12, 18 months.
I mean, I had Chris Joy on the show a few weeks ago, and he was making the point that currency buffer that we had, where we had a very strong currency, could go and buy flat screens, all the electronics, whatever we were buying with the high currency. Now that goes to a low currency, he is of the view that internal inflation is well over 3%. So whether it be your insurances, your water bills, all that sort of things are well over 3%. And this was a real drag to that number. The currency being down where it is, I'm not sure that I'm going to agree with you in respect of, we sit at 2.5 now, which is high by international standards. If we start to broach 3% because of our currency, I'm not quite sure that their weakness will be able to stymie that. I don't know that that's going to happen yet. I'm not 100% certain.
It's just time. I mean, just how long the external deflationary environment lasts compared to the internal inflationary environment.
Yeah, I just think we import a lot of it. The numbers have to come through, and we are going to sit at 2.5. I don't think we're going to go under 2. We'll be trying to stay between the band. My only concern is if we go outside the band, what they'll do is try and lift rates, which would just be catastrophic. They just can't do that. So what do they do? So where do you see cash rates? What in the medium term? Let's say this financial year, 2014.
Well, I think if you look at the short-term, long-term term deposits, it looks fairly obvious perhaps that cash rates are going to fall. But the question is, as we've been talking tonight, when do they start rising again? And that's my crystal ball's not working on that one.
What about you? Where do you see cash rates for your customers?
Look, steady to lower depending on how bad the rest of the world gets. So I'm a bit of a rest of the world bear at the moment, mainly
except for the US,
Europe and Asia. I don't think the US is as strong as you think.
Oh, I thought you were saying it was really strong. So
no, some of the housing data's been great, but anything outside of housing and cars, really up until a couple of months ago, has been still pretty tepid. Unemployment growth is still pretty tepid. So. Look, I'm a little bit bearish on the global situation in terms of rates. Therefore, I think Glenn Stevens has done a good job at keeping enough of his powder dry to still give him a tool there. It won't be the blunt instrument that the Fed has had. I think he can drop rates and try to get things going. But at the end of the day, we're a price taker, aren't we, in Australia? So it doesn't really matter what happens externally.
Yeah, and I think we probably have another cut in us this calendar year. It's just a question of the problem for the Fed. For our RBA, has been that their traditional tools haven't worked. They've dropped rates over the last 3 years, and the currency stayed really high. So they dropped them one last time, and the currency dropped them.
We need some quantitative easing.
That sort of work.
We need Glenn Stevens in a helicopter
to drop in. And if the tools don't traditionally work, I think when Stevens says, I might drop it to 2.5, I don't know how Stevens' problem, I believe, is, and you would say it, the consumer haven't responded.
It loses its impact. Quarter of a basis point, you get to a point where it's not going to cut it. Yeah. And that's why I think he's done a good job to keep that much up his sleeve. So he could, if he needed to, if Europe fell over again, he could go 1% if he needed to.
But do you not feel that the consumer themselves are much more conservative? So they're not reacting in the way they traditionally had reacted. That's the problem.
Definitely.
Don't you think that's the truth?
Definitely. They've stopped spending. I think they're concerned due to the world that we live in now. They're trying to get their head around. Yeah. You know, should I buy? You know, should I upgrade my home? Should I buy assets, or should I just sit in a corner and sit by for a while?
Yeah,
you know,
I think economics is such a big part of the dinner table conversation these days, and it probably wasn't, 5 or 10 years ago.
Yeah, and I think when you look at the numbers around the home growth, they've really exploded. Where people have just been paying off their mortgages. They've been these very conservative banker type people. They've been repairing their own balance sheet, and the Fed, our Reserve, is saying, hang on a second, I'm going to give you free money. You're not doing it. Look, we'll be back in just a moment with our final segment with Craig and with Carl, and we'll be talking about the latest in the bonds. Welcome back to the show. We have a few minutes left, so we'll take a very quick email from Richard. And Richard's asking, he's from Bondi, and he says, I've been hearing about the old structure, new structure with bonds. What is the difference? We'll be very quick. Old structure, Basel 3, new structure are hybrids, where you are told that in the event the issuer, let's say it's a bank, CBA, doesn't have enough capital, you'll get shares. That's the new structure where your CPS, you're likely to get shares probably at the worst time ever, because everyone's selling the share market. The old structure is bonds that were issued, and in the event they didn't redeem them at their first opportunity, they paid a higher interest rate. Regulator doesn't like that because there's some confusion around will they redeem the bonds at an appropriate time at the first call. Even though all the issuers redeemed them at the first call, they just said we like more certainty. So, Richard, that's the difference. It's the old structure is the redemption, and the new structure is you get shares when you don't want them. Before we wrap up, what are you worried about? What's your black swan? What's the thing that most concerns you?
The thing that most concerns me is making sure clients stick to their investment strategy. So as volatility happens, if you've set your strategy in place correctly, and this is the bucket that's got the growth assets in, and you've got your defensive assets over there, you've got the income you need, then stick with the strategy. That's not to say you don't look at individual investments and make sure you've got quality assets, but as a holistic perspective.
But are you saying set and forget? That's
not at all. No, I'm not saying set and forget.
See, I went down to the lower draw.
No. You can't set and forget now. We're not in a world of set and forget like we were perhaps 10 or 15 years ago, that's for sure. But what I am saying is to try not to keep predicting short-term movements, I guess, is how we feel.
Okay, so that's your black swan. That's what you're worried about. You're a natural warrior, I can tell. Coming from Perth, what's the low-hanging fruit?
Yeah, look, I mean, and it's almost blasphemy coming from Perth, and I think people in my home state are going to be throwing tomatoes at the screen. But look, I think in terms of low-hanging fruit, I still think there's a lot of downside in that mining and mining services sector. And I don't think we've seen, I think we're just at the beginning of the downgrade cycle for your mining services stocks like your Mon and Dalphus. Fleetwood's already been punished, we've been short that one. Wally Parsons, Forge, I mentioned tonight, Leighton's, and I think there's still plenty to come there. So in terms of low-hanging fruit, I think be smart about your investing going forward. Don't just stick it in a few banks and a couple of resource stocks and hope for the best, because I think you'd be really disappointed in a few years' time. Be really clever with your money, diversify yourself across direction, as I said earlier on the show, and don't be afraid to not be invested at any point in time. I think you have an option, and I'm glad I'm on the show tonight, because it's the not being invested part is really where your fixed interest and your cash comes in. So our most conservative level of exposure to the market is 20% in equities and 80% split evenly between cash and fixed interest. We're currently at 40% leisure market, so my models would have you at 40% invested in Australia, which is 60% cash and fixed interest. It's still 80% in America. So there are some warning signs out there. Be attentive to those signs and get a little bit smarter with your money than you might have been in the last GFC.
At this time of the year, end of 2014 financial year, what should the client, and I'm going to put you on the spot, what's his return? What should he expect? We've got cash at 2 3/4, 2.5. he should be happy with what, 5, 6, 7, 10, 15?
You know, it's hard because it depends on the client. What is their risk profile?
Rubber hits the road.
If they're an aggressive client with, I mean, I had a client come in not long ago with 90% equities in their fund, and I'm like, oh my goodness.
Yeah, but when the rubber hits the road, pull a number. You know, you can have a range, but should it be, should we be thinking 5 to 7, cash rates at 2.5, you double cash plus?
I think 5 to 7 is a good number. When you start getting to sort of 9 plus, you're going to have to be fairly aggressive in this low return world.
Carl, what do you think?
Depends on how bad the market gets. But my best year career-wise is still 2008. I made more money in 2008 than I probably will.
Want the history.
So
come on, give me the prediction.
If things get ugly over the next 12 months and markets really, really tank, then the opportunities to be short stocks and earn a return on that side is going to be extreme.
But I suppose I understand the volatility trading. I do. I like trading volatility, but what should my expectations like? I really feel 5, 7 makes sense because of where cash is going. That is such an anchor to the market. I mean, you just don't have that free give.
For us, so again, shorter term trading, get short, take advantage of it. Longer term trading, we'll be in cash. So whatever cash is, that'll be our return.
Thank you on that, Vinny. That's all we have time for today. Thank you so much to my guests, Craig Banning from NAV Wealth and Carl Capolingua, Head of Education at the Australian Stock Report. And to you, all the viewers and the calls and the emails, thank you very much. Until next time, I'm Mark Todd from FIIG Securities. Enjoy your weekend.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.